and welcome to 10 days GST series on virtual mode. Today we have CA Hanish sir. Before we move on to the technical session, I would request Chairman of Pune branch to give his welcome address.
Good evening, friends. Good evening, Hanish sir.
Good evening, sir.
On behalf of Pune branch and all the participants, I really thank Hanish sir for accepting our invitation in a minute. And also, we requested him to take IT ITES. He immediately said, yes, I will take it. Being the city of information technology, Bangalore, I requested him to take IT ITES. And I assure you, friends, after this session, you will really think the importance of this session. There are so many complications, even in IT ITES, like intermediary, place of supply, research activity, reverse charge mechanism. So many complications are there. I assure you, you will enlighten with the knowledge given by expert in the field. See Hanish sir. Thank you, sir. Thanks for accepting our invitation. Wish you all happy learning.
Thank you so much, Chairman sir. It is indeed our pleasure to have CA Hanish sir with us for enlightening us on this very complex topic. Just to introduce him, he is a partner at HSKA and Associates Bangalore. His firm specializes in the field of indirect taxes and he heads the litigation practice. He has close to 15 years of proven work experience in the field of indirect taxes. He works closely with clients engaged in very complex businesses across various sectors. He is a regular speaker at various impactful platforms across India like ICAI, ICSI, ICAMAI, FKCCI, BCIC, and CTC. So we welcome Hanish sir, and the dais is yours, sir.
Thank you so much, sir. Thank you, Chairman, sir. Thank you all the dignitaries who are present here, and thank you all the members who are participating in such large number in this program. So I think GST can never get old because the number of participants I am seeing, I am thrilled at the number of people who still want to understand and learn GST. And every day looking at the GST audits, the way the department is conducting, the way the law can be interpreted is quite innovative, meaning they might have revenue pressures because of which they are interpreting, but we will also in certain cases observe that their interpretation is sometimes logical, which is not the way we would have thought. So thank you very much everybody for participating in this large number. Now, a very interesting topic has been given to me by Rajesh sir on GST implications on IT and ITES. So initially, though I told him yes, but I thought four topics, 5 topics, maybe I may not be able to spend the entire 2 hours. But trust me now, if Rajesh sir said tomorrow also a session le lo or 2 ghante ka, so then I am sure I will be able to take that topic. But
sir, yesterday only I communicated to all my participants in each sectoral series we have to consider section from 1 to 177.
Correct.
It is not like we are covering 5 sections in one session.
Correct. Agreed, sir. Job work in jewelry industry can be treated in a completely different way versus job work in case of a regular manufacturing industry. A very interesting advanced ruling has come, and this is related to GST subject. So I just want to highlight what Rajesh sir is trying to say. In case of job work, assuming I sent 100 kgs of material and the job worker sends me back 98 kgs after finishing the goods, he is required to pay GST only on the service charges which he has collected. But a very interesting advanced ruling has been issued very recently, which says that if 100 kgs of gold is sent and 99 is sent back and 1% wastage is retained by the job worker, the total consideration received by the job worker is the service charges plus the wastage. Because that gold also is of so much value, that is the reason why he agreed for service charges at a very low rate. So from every industry, we'll have to look at these provisions. From a manufacturing industry, the job work can be completely different, but when there's a valuation for job work in case of gold is concerned, the valuation would be completely different. So I agree with sir. From section 1 to the last section, we will have to see all the sections when we are discussing with a specific industry in focus. So the topic allotted to me, or the industry allotted to me, is information technology and information technology enabled services. I'll just share my screen. Um, just give me a second. Yeah, is my screen visible?
It's visible.
Okay. Just one second, showing download. All right. So now what we'll do is we'll go to each and every topic subject wise and see what are the implications in each of the chapters relating to GST. So first we go with conditions to be satisfied in case of export. Now the conditions which are required to be satisfied in case of export of services are first, and these conditions are given under IGST Act. First, I have to be a supplier located in India if I have to treat a particular supply to be an export. Second, my customer should be outside India. Third, the place of supply of service should be outside India. That means either section 10, 11 in case of goods or 12, 13 in case of services of the IGST Act. I will have to see, because we are talking about export transaction, I will have to examine section 13 of the IGST Act, and I will have to demonstrate that the place of supply takes place outside India. Fourth, I should receive the money in convertible foreign exchange. There was an amendment to this definition where they said, in case the RBI permits you to transfer the money in Indian rupee, then even Indian rupee can be transferred, and even that will be treated as export of service. And the fifth condition is exporter and importer. That means the person who is in India, who is supplying the services, as well as the customer who is located outside India, should not be mere establishments of a distinct person. Now, for a IT ITES service concern, we all these 5 conditions are required to be satisfied. Only if these 5 conditions are satisfied, it will be treated as export of service. Even if one condition is not satisfied, it will not be an export of service. So let's try analyzing. The first 2 parts are very simple. Supplier is in India and the recipient is located outside India. Now let's look at the first point, which is being picked up in the GST audits as well. Is execution of LUT, that is legal undertaking, mandatory? That means if I'm exporting services without payment of tax, is execution of LUT by going to the GST portal mandatory or not? Assuming I have missed executing LUT, then what happens? Now, if you look at section 16 of the IGST Act, it only says export of service or export of goods will be treated as a zero rated supply. So which means export of service, I will have to only satisfy the 5 conditions. LUT is not there at all. But when you look at the refund provisions, it says when you export the goods without payment of tax, you are entitled to refund of the input tax credit subject to execution of LUT, which means I would believe that LUT is linked only to the refund provision. So if you want to claim refund of unutilized input tax credit, only then execution of LUT comes into picture. If you are not claiming refund, then LUT is not mandatory. That is point number 1. Point number 2, if you look at LUT, what does the LUT say? LUT says that I will satisfy all the conditions of export of service. And if I'm not able to satisfy the conditions of export of service, that is, I'm not able to receive the money within 1 year from the date of export, then I will repay whatever taxes are required to be paid. Which means it is only binding me if I don't satisfy the conditions of export. What if I've satisfied already all the conditions of export? That would mean that LUT is only procedural, and a non-compliance is only merely procedural non-compliance. Now, because of that, a substantial benefit in the form of payment of tax on export of service should not be fastened on me. So the point I'm trying to make here is, there are a lot of judgments even in excise, because even in excise we would export the goods under LUT. So there are a lot of judgments which say, no problem, he has not executed the LUT, he is missed executing the LUT, but as long as he has satisfied all the conditions, there is a shipping bill, there is a proof that the goods have been exported, right? And then there is a customs officer who has signed that the ship has left the shores of India, right? When all these conditions are satisfied, then a procedural non-compliance should not lead to payment of tax by the exporter. Third, initially in 2017, this LUT became a very big issue because online the GST portal was not ready. Okay, so a lot of people were not able to execute the LUT. So there, a circular was issued where it was said that the commissioner can condone if the LUT has not been taken. So I would suggest in cases where maybe in few of our cases, what we have done is that the client actually forgot execution of LUT. So we wrote a letter to the commissioner saying that, look, I have exported XYZ services. These are the amount of money which I have already received. So I've satisfied all the conditions of export of service, except that I have not executed the LUT. So please condone. And we have filed 4 applications as of now in Bangalore. None of the cases the approval is granted, but not even a clarification has been issued. So now when audit was conducted and the officers asked for the LUT, we submitted this letter and the officer closed the audit without any observations relating to export of services. Okay, so that is the first part about execution of LUT. Now let's look at the other 3 conditions which are required to be satisfied, which is first one is place of supplies outside India. Typically, GST is a destination-based consumption tax. So wherever the consumption takes place, that is where the tax has to go. So assuming I am rendering services from Bangalore to Mumbai or Bangalore to Pune, because the consumption takes place in Pune, the taxes go to the Maharashtra government. Likewise, from Bangalore, if I'm exporting services to USA, the place of supply is USA, but it is a destination-based consumption tax. Because the destination is outside India, the taxes should not be levied. So if you look at section 13, the default rule also is the place of supply is the place where the customer is located or where the service receiver is located. That is the default rule. But when you look at section 13 very closely, we have few provisions where the place of supply is not place where the services is the customer is located. It could be the place where the goods are located. It could be the place where the person has been made available, or it could also be the location of the service provider itself. So let's look at those exceptions and what are the issues which arise because of that. So if you look at the provision which I've highlighted here, it says services supplied in respect of goods which are required to be made physically available by the recipient of service. Very important here that if the goods are required to be physically made available by the recipient of service. So if a service provider is working on his own goods and exporting the services, this provision will not come into picture. This provision will come into picture only when, as per the contract, the service recipient is required to make available certain goods to the service provider, and the service provider uses those goods for the purpose of providing the service. In this case, the place of supply will be the place where the services are performed. Now, before coming to GST, we had a similar issue even in service tax, where, say, assuming a tissue, okay, was say there is a virus in Africa, and the African government wants the Indian government or the research laboratories in India to do some research around this disease. Okay, so they send some tissues, the blood samples, and whatever is required to be shared so that research can be conducted. That was sent by the one of the hospitals in Africa to an Indian research laboratory. The Indian research laboratory worked on it and was able to come up with a solution or at least share a report. Okay, so now the service tax authority started issuing notice to this research laboratory saying that as per the contract, the African hospital was required to make the goods available to you, and you have worked on those goods and only then provide the services. Now it's a different thing that can you call a tissue or a sample as goods? That is point number 1. Point number 2, those goods are not being used for rendering the output service, meaning you are not working on those goods to provide output service, but those are only incidental to the main activity of sending the research report. Now, those are not the points we are focusing now, but the point here is that if the recipient of service provides any goods and using those goods, if any services are required to be rendered by the service provider, then the place of supply will become the place where the services are performed. So we see a lot of cases where the parent company gives assets on loan to the Indian entity, and on those assets, which are the servers and the laptops, the employees work and provide export services. There could be an issue here because in this case, as per the contract, the parent company has loaned certain assets free of cost. They have provided those assets, and using those goods, the employee has, or the company, Indian entity has exported services. So that could be an issue here. Now let's look at the exception. The provision itself creates an exception which says that when the goods are temporarily imported for the purpose of repair, process, or treatment, and these goods are not going to be used in India at all, that means they're not going to be put to use in India at all, then this provision will not apply. The default rule, that is service recipient located outside India will be the place of supply, will apply. Now this exception is very important, because what would have happened otherwise is, if an Indian entity manufactures something in India, sends it to a customer, say in Germany, the German company finds some error or is not able to use the goods or machinery, they would send it back, say outside the warranty period, into India. Now, when India charges repair charges, again on that GST would be applicable, okay, because of the original rule. But thanks to this exception, which says it is temporarily imported for the purpose of repair, and after repair, without it being used in India, it is being sent out, then you are not required to pay taxes, because the place of supply will be considered based on the default rule and not the above. This also brings in another logic here, that only when the goods are used in India, the government wants to tax. When the goods are not used in India but just bought for a particular purpose and then sent back, it will not be liable to GST. Second, there is notification 4 of 2019, which has been issued as per the provisions of section 13 subsection 13. Like we have a double taxation avoidance agreement in case of income tax, even section 13 subsection 13 allows government to issue notifications where, because of place of supply provisions, there is double taxation, that is tax in India also and tax in the foreign country as well. So assuming India says whatever goods come into India, you are required to pay tax on the same, okay, and likewise now the foreign entity has to pay taxes under reverse charge mechanism on any services availed from foreign country. So now on the same transaction, the service recipient is going to pay tax under reverse charge, and the service provider is also going to pay tax on the same, because the place of supply is not within India. So in those cases, the government can issue a notification. Using those powers, notification 4 of 2019 has been issued. Now notification 4 of 2019 has been issued specifically from the perspective of pharma industry, where they have listed down a lot of activities which undertaken by the pharma companies, even if certain goods are received by them in the course of execution of the service from the foreign customer, it will not be liable to tax. So those are very technical and very specific services. I'm sure you will find it useful if you go through this notification 4 of 2019, but it has a very specific end use, and that is why I've not covered each of those line items specifically. Okay, very interesting. Okay, circular 118 of 2019 was issued specifically for ESDM industries, that is electronics, semiconductor and design manufacturing industries. Semiconductor has become very popular after COVID because of the shortage of chips. Okay, so ESDM is the specific industry for which a circular was issued, and this circular now can be used for as a logic for other industries also. Unlike notification 4 of 2019, which is applicable precisely only for pharma industries, the logic of circular 118 can be used for any industry. Now let's look at what does the ESDM circular say. The ESDM circular clarifies that an Indian entity might get a contract for development of software. Now, as part of development, now, what are we talking about in this ESDM? So, assuming we are talking about a motherboard, okay, we are talking about a chip, okay. Now, how does the chip perform? Okay, what should be the instruction? Where should be the start button? Where should be the end button? What will be the communication lines? All of this is integrated in a chip, okay, or a motherboard, okay, or an integrated circuit board, whichever way we want to call it, okay. So now in this integrated circuit board, which is available with the US entity, assuming they want us to develop software which can talk between hardware and software, okay, and also wants us to give a perfect design so that the phone is as slim as possible. So assuming we are talking about a motherboard of a phone, okay, so they want the Indian entity to develop the software on which the phone will work, and also design the motherboard in such a way that it is as sleek as possible, okay. So Indian entity has got this contract. As per the contract, software has been developed and given. The design has also been done and it is being given, okay. It is exported by way of email, assuming, okay. Now the entity outside India, that is the US entity, says, okay, this is okay, but I want to see whether this is workable on a prototype or not. So they now send the hardware parts, and the Indian entity is expected to upload the software or integrate the software and also check whether this prototype is working or not. So theory is fine, but practically also whether this prototype is working or not is what the expectation of the customer is. So now for this ESDM manufacturers, are required to test the prototype and send the results also. That out of 10 times when I clicked switch on, it switched on 9 times. So it is a 9 out of 10, which is better, but it can be improved, or it is 9.5 times. Okay, so if the sample is very high, there are 50, 60 phones which have been given. So 9.5 times rating I have got. Okay, so the test reports is also required to be submitted. Now, in this case, the department was taking a view that because the prototype has been made available in India, the place of supply is the place where the services have been performed. The service of testing is performed in India. That means the entire service has been performed in India. So place of supply is India. And so this transaction is not export. It is a transaction which will be made liable to GST. Okay, so the circular now says that actual process is actually software development and design. And this is an entire composite supply where testing is also involved. Testing is not important, but it is ancillary to check whether the first two services have functioned properly or not. Because this entire process is a composite supply, which cannot be artificially vivisected to say, okay, this much consideration is for software, this much consideration is for design, this consideration is for testing. Because the single contract being a composite supply cannot be vivisected or should not be vivisected artificially, this is a composite supply of software development, or this is a composite supply of design services. And in this case, the place of supply will always be the default rule, which is the place where the customer is located. And so this services, even though the goods have been imported into India for testing purposes, it will still qualify to be export of services. Okay, so there's a beautiful clarification which has been given. Next, move on to the next entry, intermediary services. Okay, so if you look at section 13 subsection 8, there are 3 services which have been listed down, where the place of supply is the place where the service provider is located. I'm sorry, there's a typo error. Where the service provider is located, not the service provided is located. So I'm sorry for that. I will just make this change. Give me a second. Okay. Right. So now these are the cases where, even though all the other conditions are satisfied, okay, with respect to export of service, but because place of supply is the place where the Indian entity is located, okay, it will not qualify to be an export service. Okay, now let's look at what do you mean by intermediary services. Okay, now if you look at the definition of intermediary services, it says a broker, a agent, or any person by whatever name called, who arranges or facilitates the supply of goods or services, or both, or securities between 2 or more persons, but does not include a person who supplies such goods or services, or both, or securities on his own account. So now if you observe here, the definition is very clear. It talks about a person who acts like a broker, who acts like an agent. Okay, so that means he does not provide services on his own. His role is to only link person A with person B. Person A has certain goods or services. Person B requires those goods or services. He links the two and says, look, he will be able to give you the goods. Look, he will be able to purchase your goods or services. So he is a broker or an agent who arranges or facilitates. Now, this word facilitates can be very, very confusing, because there is no meaning to this facilitates, because it's an English word and it's not a legal term. So there's no definition in GST for the term facilitates, and the term facilitates can be quite broad. Okay, just to take an example, if I want goods from Flipkart, okay, I order something from Flipkart. Flipkart uses a transportation service to deliver the goods to me. The transporter is facilitating the transaction between Flipkart and me. But actually, is it an intermediary? No, he is not a broker. He is not an agent. In fact, he is coming to picture after the sale has got concluded. Okay, so he cannot be treated as an intermediary. Intermediary is a one who comes into picture even before the sale takes place, and because of him, the sale takes place, because he is identifying the parties and introducing both the parties. Okay, so this word facilitates can be quite confusing, and because of the vast extent to which it can spread, there are very absurd notices which have been issued by the department. If you look at the service tax also, and as well as GST, the moment in the agreement they see the word customer interaction, if they see the word that you are doing some marketing of the product, okay, just do a control F in the agreement, some 4-5 standard words are available, are checked. If it is checked, the refund claim itself is rejected, saying you are not doing software, you are not doing BPO KPO services, What you are doing is intermediary services. The place of supply is in India only. Forget refund. You are required to pay output tax on the services, on the invoices which have been raised by you. Okay. Now, in this case, Circular 107 of 2019 was issued. Okay. As far as ITS services are concerned, because there was a lot of notices which were issued as far as BPO, back-end operation services, were concerned. Okay. So now there it was clarified that back office operations, call center, data processing, data mining, insurance claim, so many other services. Now these are services which have been given on own account by the Indian entity to the foreign entity. These cannot be treated as intermediary services at all, because these are like back-end operations for a company and does not require any link with the end customer. That was the circular. But unfortunately, this circular was withdrawn because some of the wordings of the circular are not very clear. So based on the apprehensions, the circular was withdrawn by another circular, Circular 127 of 2019. So though principally we can go and look at the guidance of what the department thinks is the intermediary service, but legally this circular is of no use because the circular has been withdrawn. Okay. Now again we go back to another circular, Circular 159 of 2021. This is mainly drawing inspiration from the education guide which was issued in 1st July 2012, when service tax based on negative list regime was introduced. Okay, so mainly almost all the features given in the circular are borrowed from that education guide itself. So what the circular essentially says, though at the end it says based on the facts of the case only you will decide whether it is an intermediary or not, but it says intermediary means there should be 3 transacting parties. So let's take an example. I am doing accounts of a company who is in USA. Okay, so they send me the vouchers and I do accounting. That cannot be an intermediary service because there are only 2 parties here. Okay, there have to be minimum 3 parties. Only then intermediary service will come into picture. Second, there should be 2 distinct supply. One, the US entity is supplying services to the end customer, and I am rendering some services either to the US entity or to the Indian customer by linking both of them. So let's take an example that there is a US entity who is searching for a customer in India who can say import their very heavy equipment which is used in medical field, say assuming oxygen cylinders, okay, which were required during the COVID period. Okay, so a machine which can manufacture oxygen very quickly. Okay, so a very expensive machine. They want customers, so they want some hospitals to be identified. There is a person in India who has a lot of clout in all the hospital industry. So this person is identified and he said, look, this is the demo of the product. You go to all the hospitals and link us to these hospitals if they are interested. So the job of the agent now, or the person who is working now on behalf of the US entity, is that he will search for the hospitals who are interested in this product. So then now you would observe there are 2 supplies. One, if the transaction goes through, then the US entity has sold this oxygen manufacturing machine to a hospital. That is the main activity. And the incidental or a facilitating supply is that the agent has either collected commission from the hospital saying that, look, I got you a link of the oxygen manufacturing machine or manufacturer, okay, or he collects commission from the foreign entity and says, look, I have got you a customer. So there are 2 services involved in case of an intermediary, one being the main supply of goods and services, and second, a facilitating supply. Third, it should be a transaction which will lead to facilitation of a transaction between buyer and seller. Okay, so let's take another example. Okay, I already have a customer in India. So there is a US insurance company, okay, who already has a customer in India. But because there is somebody who is required to liaison with him, another person has been appointed. Okay, so here he is not facilitating the transaction of supply of goods and services. Who is an intermediary who arranges or facilitates supply of goods and services? The supply of goods and services has already taken place. But as part of a AMC, another person has been appointed who is required to take care of the requirements of the Indian customer. Here, the Indian vendor, that is the intermediate, the person who is in between, is not facilitating the transaction. The transaction already taken place. So that cannot be treated as an intermediary services. Fourth, when it is a principal to principal supply, where the other person is not acting as an agent, so he's not acting on behalf of anybody, but he's acting in his own rights, then that the service cannot be treated as an intermediary service. Fifth, if somebody subcontracts a portion of their own work to another person, then that subcontracting cannot be treated as an intermediary services. right? So for different situations, all these criteria may be useful for us to decide whether the service qualifies to be an intermediary service or not. Okay. Also, additional condition which was mentioned in the education guide is that generally or typically in case of intermediary services, the fee is collected by the intermediary as a percentage of the total contract. So if you look at if I have to find a house on rent, they'll say 1 month rent or 8.33% rent. Okay. Or if there is a job portal who helps me recruit people, then 1 month salary is what will be collected. If somebody helps me sell my land, then 1%, 2% commission of the total agreed sale value of the land will be collected. So though the education guide said consideration cannot decide the nature of the transaction, but typically in case of intermediary services, the service fee is collected on a success fee basis and a percentage of a contract. So if the contract does not go through, there will be no service fee. And if the contract goes through, the percentage of the contract value will be collected as the fee by the intermediary. Okay. Now, these are the factors which can be kept in mind to check whether our customers or our clients are engaged in services which qualifies to be intermediary or not. Few other activities which we can look at. Okay, I thought we can look at these activities. Okay, if it is marketing, definitely there is an issue. But when the service is relating to market research, then it is a completely different activity. So marketing, though arguable, but market research is a completely different activity. Now, what is the difference between marketing versus market research? I, as a person who is representing a US entity, give advertisement in the newspaper and give my phone number as well. The customer connects to me. I explain the product features, and then these numbers of all the leads, I transfer it to the US entity, who now starts communicating and supplies the goods to the or the services to the Indian customer. That is called marketing. But when it talks about market research, there the US entity only says you go in the open field and check whether my goods or services which I'm offering, whether there is a market for that or not. How many people will be ready to buy? What is the target audience? What is the average budget they are ready to spend on the product which I want to launch in India? Right? So market research would require giving a report and not the contacts of the end customer. So market research is not intermediary, but marketing, advertisement, okay, could be, I'm not saying 100%, could be an intermediary service. Second, like we mentioned earlier also, identifying clients could be an intermediary service, but interacting with the pre-existing or pre-identified clients for us after sales service is not intermediary service. Okay. Third, based on the education guide, if my contract is cost plus, that means I am receiving money, the Indian entity is receiving money at cost plus, okay, then it may not be an intermediary. Whereas if I'm getting revenue based on a percentage of the transaction, then there is a small subtle hint that this could be an intermediary service. Okay. Fourth, we had a very interesting issue where the entire contract was something similar to marketing, but now the consideration was the total team's salary plus whatever cost they have incurred, the rent wherever they are occupied. So total cost of the 10 or 15 employees plus a 15% margin, whatever was the acceptable margin, 15% margin was agreed to be compensated by the foreign entity, irrespective of whether they make the sale or not. So an interesting argument which we took up before the tribunal, and this matter has still not been decided, is that look, intermediary means he has to facilitate a transaction between two parties. In my case, I have been in existence from the last 3 years. I am billing cost plus, but I get a letter or a declaration from the foreign entity that till now they have not supplied even one product or one services, or they have not delivered even one product or service, or have got any inquiry in India. Okay, so I am receiving consideration irrespective of business which has been earned. That means I'm not facilitated any transaction at all. That means even though I might be fitting very close to an intermediary, but I am not an intermediary because I'm not facilitated any transaction. Okay, then another argument which we could take is, if majority of my employees are engineers and not marketing guys, then just a thought. Okay, this is not something which has come out in any judgment, but this could be another argument that look at my composition of employees. If they are engineers, then I cannot be an intermediary. But if these guys are marketing guys, then of course there is a possibility that it could be an intermediary service. Now this intermediary service works in two ways. Let's take an example. Okay, I have a foreign vendor and I'm trying to find customers for my foreign vendors in India, for my foreign vendor in India, the commission what I receive from the foreign vendor will not be treated as export of service, and so I'm required to pay GST on the same. Okay, that is one way to look at it. The other way is, if I'm an Indian manufacturer who is finding out foreign customers and for which I identify a foreign agent and I pay commission to him, generally foreign currency expenditure, I'm required to pay tax under reverse charge mechanism. But in this case, because this service is an intermediary service, and as per section 13 subsection 8, the place of supply is the place where the person is located, and the person is located outside India, because the place of supply is not in India, this agency commission paid to a foreign agent by an Indian entity will not be liable to tax in the hands of the Indian entity under reverse charge mechanism. Okay. Next, the next condition in case of export of services, that the transacting parties should not be mere establishments of distinct person. Now, what do you mean by mere establishments of distinct person? That definition is given in explanation 1 under section 8, which says an establishment in India or any other establishment outside India will be deemed to be distinct person. So what they are trying to say, assume, and that explanation 8 continues to say, distinct person we are used to when we talk about in the Indian context. So I have a branch in Pune where I've taken GST registration. I have another branch in Bangalore where I've taken a GST registration. So both these are branches. For income tax purposes, there is one PAN. For Companies Act purposes, there is one balance sheet. Okay. But for the purpose of GST law, because I've taken 2 different registrations, this will be treated as distinct persons. Okay. Like section 8 extends this to a branch in India, and a branch outside India will also be treated as distinct person. That means they'll be treated as 2 separate persons. Okay. Now, export of services, section 8 has deemed these 2 people as distinct. But for the purpose of export, you should not be distinct person because of section 8. You should actually be distinct person. That means for the purpose of export of services, even though for all the other purposes you are 2 separate persons, but for the purpose of export of service, you are not separate persons. And so when you export something to your branch, that will not be treated as export of services. Okay. Now that means, now what happens when I'm transacting with my overseas branch? So I'm in India and I have an overseas branch in Singapore. Okay. Because I'm not treated as because transaction between distinct persons are not recognized as export, these export of services to branches will not qualify to be exports at all. Okay. Second, but now notification 15 of 2018 has been issued to amend the notification 9 of 2017, where another entry was added, serial number 10F, which says transaction between Indian branch and foreign branch will be exempt. So it will not be treated as export, but it will not be treated as taxable also. So it will be exempt service. Okay. Now, when it is an exempt service, we all know rule 42 and 43 will come into picture. Anything specifically used for export of services to a foreign branch, I will have to reverse the credit. And anything commonly used for taxable and exempt purposes, that also I will reverse. A fundamental question which comes in our mind is, how can a branch export services to another branch? Both are separate, both are same persons itself. Okay. But if they are branch accounting, because of which they are working on a cost center model, where if India incurs some cost for the purpose of foreign branch, and then foreign branch uses that services to export, and because of which in books there is a cross charge, okay, between the Indian entity and the foreign entity, for Indian branch and the foreign branch, then this issue might come up. But luckily from 2018, this service is exempt, so you're not required to pay output tax. But the issue is input tax credit could be an issue or could be a challenge. Okay. Now, instead of a branch, what if I have a sister concern? Now, in this case, I am a separate legal entity. I am in India. I have a certificate from Ministry of Corporate Affairs that I am an entity registered in India if I'm a company. And they also would have got incorporated or got registered in the local laws which is applicable to them. So there's a circular which was issued in 2021, circular 161, which very clearly says that if the provision is applicable only for branches, if the service provider and the service receiver are respectively registered in each of the jurisdictions where they're operating, okay, then these are treated as separate persons only, and so transaction between the two will be treated as export. Okay. Now, one very interesting point which we will have to see here is that for the purpose of export, Indian branch and foreign branch is not treated as separate persons, so this does not qualify to be export. but this exception has not been carved out in import of services. So now, because explanation 1 to section 8 says your foreign branch and you are separate, and assuming foreign branch does some work for you, and from an accounting purpose, they cross charge something to you, unfortunately, you will be required to pay taxes on the same under reverse charge mechanism, because unlike export, in import, this exception has not been carved out, that the services received from a distinct person will not be treated as import of service. So the services to the distinct person outside India will not be treated as export. Services by the distinct person from outside India into India will still be liable to tax under reverse charge mechanism. Okay. The last condition which we saw in the definition was receipt of money in convertible foreign exchange, except where the RBI allows for receipt of money in Indian rupees. So there a very interesting issue which came up for consideration is in case of subcontracting. Okay, there is a circular 78 of 2018 which has been issued. Now there they are giving an example where they say if XYZ in USA hires ABC in India to render certain services, which is say 1 crore. Okay, India in turn hires a Singapore entity and subcontracts 40% of the services to the Singapore entity. The entire amount had to come, that is 1 crore rupees or 1 crore dollars, had to come to the Indian entity only. But for some reason, 40% of the work which was subcontracted to Singapore, the US entity has transferred 40% of that funds to the Singapore entity. And the balance amount, which is 60%, has been given to the Indian entity. Now, in the hands of the Indian entity, they have raised the invoice of 1 crore dollars, but they have received only 60%, which is 60 lakhs. Okay. So now, will it be considered as receipt of money in convertible foreign exchange, or will it be considered as receipt of non-receipt of money in convertible foreign exchange? So it will not be treated as export. So here, the circular says that even if the money has been received by the Singapore entity, it will be treated that the Indian entity has received the entire 100%, and they have paid 40% to the Singapore entity because they have received the services from the Singapore entity to the extent of 40%. They have availed services from a foreign vendor. It is liable to tax under reverse charge mechanism. So on that 40%, they will have to pay tax under reverse charge mechanism. And all of this will be allowed only if a general or a specific approval from the RBI is obtained that yes, you are entitled to retain the foreign currency outside India, that is 40% can be directly paid to the Singapore entity. Only if this last condition is satisfied, then as far as the Indian entity is concerned, it will be considered that they have received the entire money in convertible foreign exchange. So this qualifies to be an export, and also that they have paid 40% to the foreign entity on which they are required to pay tax under reverse charge mechanism. Okay. Next. Now the word permitted by RBI in Indian rupees is very, very important. Okay. So there another circular 88 of 2019 has been issued, and I'm pardon me for my ignorance on this subject because this is more related to FEMA. But under FEMA, if you look at the master circular said export proceeds against specific exports may also be realized in rupees, provided it is through a freely convertible Vostro account of a non-resident bank situated in any country other than a member country of Asian Clearing Union or Nepal or Bhutan. I have no idea about all this. Only thing is, I just asked the client, please take an opinion from your FEMA experts that it satisfies these conditions which has been laid down by the master circular under FEMA. If it satisfies, then we will take the benefit of circular 88 of 2019 that the money has come from Vostro account of a non-resident bank situated in country other than ACU, okay, or Nepal or Bhutan. And so even if the money has been received in INR, it is treated as export. So there I recollect in foreign trade policy, okay, if you look at the foreign trade policy, I think chapter 2 or chapter 3, it allows for receipt of money either from Iran or Israel in INR. And that is where the trade between Iran and Israel and with India was increased to a good extent because it is allowed to be in Indian rupees. Now I'm not sure about the foreign trade policy procedure, but at least 2-3 years back when I read that, there was a mention of settlement of transaction in Indian rupees between these two countries. Okay. Second, services to Nepal and Bhutan. FEMA does not give a specific guideline that you can receive the money from Nepal and Bhutan in Indian rupees. If you look at the earlier provision, which is an extract of the master circular, which is being given in the circular 88, it says other than Nepal or Bhutan. So even if you receive convertible money through a convertible Vostro account of a non-resident bank from Nepal or Bhutan, it will not be treated as receipt of money permitted by RBI, receipt of money in INR permitted by RBI. So it will be liable to tax, or it will be treated as a condition violated as far as export of services is concerned. So now what happens to services to Nepal or Bhutan? Again, notification 9 of 2017, which is the exemption notification under the IGST Act, has been amended by notification 42 of 2017, where serial number 10D has been added, which says even if you receive the money in INR, as far as the place of supply is concerned is Nepal or Bhutan, that service will be exempt. So the point is the service will be exempt. That means credits will have to be reversed. There again, there was explanation under Rule 43, which says these are the transactions which should not be considered as exempt for the purpose of turnover. So if you recollect, if you have to reverse Rule 42 and credits as per Rule 42 and 43, the explanation to Rule 43 says interest earned by you, though it is exempt turnover, you are not required to consider it as exempt turnover for the purpose of computation of reversal of credit. So there, this notification 42 of 2017 amendment was also included. But notification 3 of 2019 has been of the CGST Act has amended the explanation under Rule 42 to remove reference to notification 42 of 2017. The sum and substance of this amendment is that now when services are rendered to Nepal or Bhutan, where the place of supply is also Nepal and Bhutan, and you have not received the money in convertible foreign exchange, but you have received the money in INR, you are not required to pay output tax, but you will be required to reverse the input tax credit, because the exclusion of from exempt turnover is not available from 2019 onwards. Okay. Now, one very interesting thing which has come up very recently in November 22, 2023, I would request all our members to have a look at this master circular issued by the RBI. It is updated on, so because the circular is issued and then it keeps on getting amended. So updated as on November 22, 2023, there is Roman number 7. Another section has been added, which is international trade settlement in Indian rupees, where the Indian government has now said that you can contract in Indian rupees, you can bill in Indian rupees, and if certain conditions, 7C, conditions are satisfied by the AD, then you can receive the money also in convertible form in Indian rupees. So now very interesting, if I'm able to satisfy the conditions under Roman number 7 para C, okay, and I can just read it out for you. It's, again, I will not be able to understand this. In terms of regulation 7 of FEMDR rules, regulations 2016, AD banks in India have been permitted to open rupee Vostro accounts. Accordingly, for settlement of trade transactions with any country, AD bank in India may open special rupee Vostro accounts of correspondent banks of the partner trading country. So if you satisfy this condition, if the AD satisfies this condition and has a special rupee Vostro account, even if you receive the money from your customer in outside India in INR, it will be receipt of money as per the guidelines prescribed or permitted by the RBI, which will still be treated as export of service, and you will get the benefit of exports. Okay. Now, we've discussed a lot about exports. Now let's move to import of service. Right. So now here, let's summarize all the provisions relating to import of service. Because if you look at section 7, okay, first you go to section 7. Section 7 says there should be a supply for consideration in the course of business, that is 7.1a. Then 7.1b comes into picture, which says import of services for consideration, whether or not in the course of business, is liable to be taxed. Okay. Then we go to schedule 1. It says import of services between distinct persons and related parties, even if without consideration, is liable to tax. Okay. So let's summarize all these provisions by way of a flowchart. So if we are talking about import of services, and this import of services takes place for a consideration, that means the amount has been paid, and this consideration has been paid by somebody who qualifies the definition of business given under section 2 subsection 17. Okay. Then that business is required to pay tax on the same under reverse charge mechanism. And assuming that consideration has been paid for import of service, but the end use is personal in nature, then if the service is a OIDR service, then OIDAR is required to pay tax under forward charge mechanism. Okay. But if the service is not a OIDAR, then there'll be no GST at all. We will discuss all of these aspects. So let's take example for each of these aspects. Okay. So assuming that I want to construct a building. Okay, and constructing a building, I require an architect who is from outside India. I want a Singapore architect to design the building. Okay, and I'm in the business of constructing the building and either selling it as is or renting it out. Okay, so now because I qualify the definition of business and under section 2 subsection 17, I have paid money to the architect. Architect has designed my building. Okay, so in this case, the services have been received by me. Place of supply is the place where the immobile property is located. So I am required to pay taxes under reverse charge mechanism on whatever consideration I have paid to the architect. That is import of service for consideration in the course of business. Okay. Now let's look at import of services for consideration for personal use. So I am an individual who has Netflix subscription. Okay. So I pay to Netflix 500 rupees, 600 rupees or 1000 rupees, whatever the subscription charges are. Okay. So now I am an individual who is not in the business, but at my home at leisure, I watch Netflix. So this is a online information database access retrieval services. Okay. Now, what do you mean by OIDR service? Though it is proposed to be amended based on the Finance Bill 2023. Okay. But just before the amendment takes place, look at the name online. That means the service has to be rendered online. It has to be an information or a database which is allowed to be accessed by me or retrieved by me. So very simple example, Netflix, which will allow me to retrieve a movie or access a movie online. Okay. Or say Amazon Kindle, which allows me to access the ebooks, or a Google Drive, which allows me to retrieve the photos which have been uploaded by me. So all these services qualify to be a OIDR service. The service provider himself, even though he's outside India, has to mandatorily register in India and he will have to pay tax. So very interesting. Okay. So now assuming you want to take a subscription of Google Drive, okay, which is say 130 rupees per month. Now, when you log into the Google website and say you want Google Drive subscription for a month, it will say 130 rupees plus GST. The moment you add your GST number to it, the GST vanishes. Now, that's not a promo code. Okay, very bad joke, I know, but that's not a promo code. It means that the moment you've given GST number, it is no longer for personal purposes. It is now for business purpose. And because there is a consideration involved, Google will not pay the tax. Now you are required to pay tax under reverse charge mechanism. Okay. But when you don't give your GST number, Google understands, or Facebook, LinkedIn, everybody understands that you are not business. So they will be treated as OIDR and they will have to pay taxes on the money collected by them from all the Indian customers. Okay. Now, if the service is not OIDR, assuming I am an individual who is constructing a house for my own self, not for selling, not for renting out, okay, for my own purpose, okay, I am constructing a house. So I appoint an architect who is from Singapore and I pay him money. So there is import of service, there is consideration. Now this consideration is for personal purposes. In this case, no GST will be applicable because the service has been rendered to a non-taxable person. Okay. Then import of service, not for consideration. Now here the criteria is different. If the service is rendered to a related party, that means the related party is in India has imported the services from a foreign vendor, it will be liable to tax under reverse charge mechanism, even though there is no consideration attached. Now, if it is not a related party, then there is no GST. So assuming we all use Facebook, we all use Instagram, okay, the IP of this website is outside India. Okay, this is not a chargeable activity at all of they allowing us access to Facebook or Instagram. Okay, so there is no consideration involved. And now Facebook and I are not related to each other, though Facebook knows a lot of my information than my relatives, but still Facebook is not related to me. So now, even though I access their website, because there is no consideration, there is no GST applicable. But now assuming, okay, there is a foreign entity who is providing some software to the Indian entity, and the Indian entity is using that software for their business purposes. So if both are related to each other, even though no consideration has been charged, okay, no consideration has been charged by the foreign entity to the Indian entity for providing the proprietary software, it can be treated as import of service and hence it will be liable to tax under reverse charge mechanism. Okay, valuation could be a big issue, but will it be liable to tax? Yes, it could be liable to tax. Okay. Now let's look at few more issues around import of service. Okay. As far as IT ITES is concerned. Now, Forex remittances as per notes to accounts, you will have to have a look at the notes to accounts and bifurcate all those expenses into what are services, what are goods, in goods, what are goods and what are capital goods. Only services will be liable to tax under reverse charge mechanism, because on goods and capital goods, you would have already paid taxes when you would have imported the goods. Okay. One very interesting issue which can come up is, now there is a mechanism where I'm told that wherever those CA certificates are issued to say TDS is required to be deducted, TDS is not required to be deducted, okay, the GST department has been given those information, or access has been given to those data, based on which they can now compute that what are the foreign transactions on which TDS had been deducted, and whether the service provider, the recipient of service, has paid GST under reverse charge mechanism on import of service, at least to that extent. Okay, so wherever the TDS is being deducted, that is a confirmation, maybe an indirect confirmation or affirmation that this could be a service, the underlying transaction could be a service. So we have to be very careful when the TDS certificates are being uploaded, or maybe if we are doing only GST, we might have to ask the client that please give me a report of transactions where TDS have been deducted, and let's map it or match it with the RCM import of service register which are giving me, to see if any line items have been missed. Okay, then again a very interesting issue. So now, pardon me for my ignorance of income tax as well. So I'll take some assumptions. Even if it is wrong, please pardon me for that. So if I am paying Google 1 lakh rupees for using their services, okay, and I'm required to deduct TDS of 10%. Google says that Google could be a wrong example, but let's take another software company. Okay, I have paid them 1 lakh rupees, but because of income tax, I'm required to deduct a TDS of say 15%. Okay, so I finally pay them 85,000 only. They will say that you have paid me 85,000. You are entitled to services worth 85,000 only and not 1 lakh. Now I cannot argue with them that my Indian laws require me to deduct 15%. So what I'll do, I will gross it up and ensure that he gets 1 lakh, and I will deposit some money to the Indian government as income tax deducted or TDS deducted for the foreign payment which I have made. Okay. The issue which comes up now is, say assuming it is 1 lakh rupees I have paid to the foreign vendor, and say 16,000 rupees I have paid to the Indian government as TDS. So in my books, the total expenditure for that service now is 1,16,000 rupees. Okay. The issue now is whether I am required to pay GST under reverse charge mechanism on that 1 lakh rupees, which is the amount actually paid to the vendor, or it is 1,16,000 rupees, which is the amount paid to the vendor plus to the Indian government. Okay. There are contradictory judgments on this issue in service tax. There's one judgment which says that you are required to pay whatever you were liable to pay to the vendor, which is 1 lakh. So you are required to pay tax only on the 1 lakh rupees. There is another judgment which says finally the obligation out of this entire transaction was 1,16,000 rupees. So you are required to pay GST under reverse charge, service tax under reverse charge mechanism on the 1,16,000 rupees. So now I'm told that this matters before a few high courts, but no judgment has come. But what happens in GST is there are two important sections. So we'll take it one by one. Section 15 subsection 2 says that to the transaction value, which is 1 lakh rupees, add anything which is a tax other than GST. So add anything which is other than GST, which is a tax, is what section 15 says. So because of this, now if you observe in case of tobacco where excise duty is also applicable and GST is also applicable, I am required to pay GST even on the excise portion on tobacco. Okay. So likewise, if there are any transactions where any tax has to be charged separately, which is not part of the GST domain, right, or part of the GST universe, on that also GST will have to be charged because of a mandate specifically under section 15 subsection 2. Okay. An interesting issue which came up is in case I buy a car, the dealer is required to collect taxes from me, that is TCS. Okay. We are talking about TDS, just deviate or digress a little. So there the dealer is required to collect taxes from me. So if the value of the car is 10 lakh, he will collect from me 10 lakh, 10,000, 10 lakh for the car, and 10,000 will deposit in my account. Whenever I file the return, the 10,000 will be available to me as deduction. So the question which came up was whether this TCS is also required to be added for the purpose of computation of GST. So a circular was issued. I'm sorry, I'm not given the reference of that circular. Okay, but a circular was issued which said that TCS is a tax. So under 15 subsection 2, any tax other than GST has to be added. So add that, and on that amount GST is required to be paid. Now in Kerala High Court, this circular was challenged, where they said, look, point number 1, TCS is a mechanism to collect tax. it is not under the charging section. It is under collection of taxes chapter that TCS is collected from the customer. Okay, so that is point number 1. Point number 2, TCS is collected on the invoice value. So now if 10 lakh is including GST and I collect TCS on that at 1%, which is 10,000 rupees, you ask me to pay GST again on that. So on 10,000 I add GST, right? So the invoice value increases. Then again on that I collect TCS. So what will come first? Whether TCS will come first or GST? I'll keep working on this. Okay. So then the Kerala High Court said, yes, TCS is a collection mechanism. It's not a tax. So we cannot ask for payment of GST on TCS as well. Okay. So basis this, the circular was challenged, and then a next circular was issued amending the original circular saying, yes, TCS is a tax, is a collection of tax and not a tax. So you are not required to pay tax on the same. So whether similar arguments will be applicable even in case of TDS, because TDS is also a collection of tax. If I'm a salaried employee, I am not paying taxes when the employer retains TDS from me. At the end of the year, the total salary I am required to pay the tax. The TDS which is being deducted by the employer and deposited will get adjusted. But that is the income tax. TDS is only a mechanism to collect that money from me in advance. Okay, so similar logic can apply. Now here, a few of my friends who practice in income tax, they said TDS provision as far as non-recipient is concerned is on a different footing, because TDS has to be deducted to the extent of the rate of tax applicable to that unless there is a DTA. Okay, so that means if he was in India, what is the income tax he would have paid? That extent TDS has to be deducted. Okay, so which means that this TDS could be in the nature of income tax. So that section 15 will come into picture. These transactions or these arguments are not tested. I am just highlighting this as far as whatever I have been made aware of from the payments by grossing up of TDS is concerned. Second, very interesting, section 15 subsection 2 also has a provision which says amount liable to be paid by the supplier but incurred by the recipient. So another argument which one of my friend came up with in income tax discussion was that the supplier who is not in India was actually supposed to pay this amount, but because he's outside, this amount is being incurred by the recipient. So that could be another argument with the department to say that grossed up TDS also will be liable to GST. What is my view? In my view, the grossing up of TDS is only a statutory requirement under the income tax law. But my consideration, as far as my recipient, my supplier is concerned, is only $1 lakh or 1 lakh rupees, whatever agreed. GST is applicable on the value of services received by me. The value of service received by me is $1 lakh or 1 lakh rupees, or the invoice which has been raised by my supplier, and so I am required to pay taxes on the same. Now there are counter arguments possible to it. This will have to be tested at the higher forums. Even in service tax, this is not a settled issue, so we will have to wait for some time before we get a final answer. But this is my view, which definitely is subject to interpretation from your end as well, which I will take it up in the Q&A answer whenever you ask the question. Okay. Next, transactions with related parties, like we just observed, liable to tax even if there is no consideration. Okay, so even if there is no consideration, even if I make a book entry, in fact, if you look at the next point, time of supply in case of import of services with associated enterprises is the day when I actually receive the money or the day when I pass the entry in my books of accounts. Even if it is a provisional entry, as far as an entry has been made in the books of accounts, that becomes the time of supply, and that is the time when I'm required to pay tax under reverse charge mechanism. Okay. Then deputation of manpower. Okay, so what would happen? That there is a project which is being given by the US entity to the Indian subsidiary. Okay, to manage that project, a foreign director or a foreign employee, technical employee, is in India. The Indian entity now pays salary to the to the foreign deputy. Okay, or they reimburse the cost. So now the argument was that the foreign employee who has been deputed for India operations now is an Indian employee only, because PT is deducted, PF is deducted, everything is there. He might be on rolls of both because he does not want to sacrifice social security number or social security emoluments in US. So he might be in dual employment. But as far as India is concerned, whatever money I am paying him, also I am deducting the salary and I am deducting the TDS also under salary. So the consideration paid to him is a transaction between the employee and the employer, and hence not liable to GST. This was a similar argument which was taken up in service tax as well. Now in service tax, Northern Operating Systems, Honorable Supreme Court in the case before them, based on the facts which were available with them, they said that no, this deputation of manpower is a service rendered by the foreign entity to the Indian entity, and so it will be liable to tax under reverse charge mechanism. Basis this, a lot of notices or inquiries have been issued to a lot of multinationals that please give us details of whatever money you have paid by way of consideration towards deputation of foreign employees. And as soon as the data has been shared with the authorities, the DGGI and the other enforcement authorities or intelligence authorities, a show cause notice will be issued or is in the process of being issued based on Northern Operating Systems case, which is a Supreme Court judgment. So now if any of our clients are engaged in deputation of manpower from a foreign country, then we will have to examine those transactions and also specifically look at the facts which were before the Supreme Court in Northern Operating Systems and see if it matches with the facts available. Now, there could be a possibility that the facts could be a little different, so we can argue that no, the facts are completely different. But the point is, on a principle basis, this decision has already been taken. So either we adhere to it and then claim the input tax credit, or wait for the notice and then go to the Supreme Court or go to the higher forums and then litigate on this issue. Okay. Now, these IT ITES companies, especially in Bangalore, can spoil the employees. Okay, so now let's look at what are the transactions which take place between the employee and the employer. If you look at Schedule 3, transaction between the employee and the employer in the course of employment is not liable to GST. And thanks to a very interesting circular, the notice pay recovery collected by the employer from the employee will not be treated as tolerating an act, and so that will also not be liable to GST. And in fact, if you paid the taxes, you can claim refund also of the same. Okay. Now, employee to employee in the course of employment is not treated as a supply of goods or services, which means on the salary, luckily the employee is not required to pay GST. Okay, that is the importance of Schedule 3. That also means, if you look at the provision very carefully, it is only talking about employee to employer, and that too in the course of employment. What if employee renders services to employer not in the course of employment? So let's take an example. I have an employee with me and I am paying him a lakh of salary. Okay. Now he has a commercial property where he has some 5,000 square feet available for rent, and I am looking for an office space. Okay. So now I take that office space on rent and I am paying him 5 lakh rupees rent. So every month I am paying him 6 lakh rupees, 1 lakh towards salary, 5 lakh towards rent. Okay. Under income tax also, under different provisions, I am deducting TDS. Okay. So now the first transaction of 1 lakh rupees will not be liable to GST because it is employee to the employer in the course of employment. But whereas the second transaction is concerned, it is not by employee to employer in the course of employment. His employment contract does not say that you will be hired only if you give the property on rent. Okay. So he is now stepping in the shoes of a landowner. So because of that, it will not be covered, or the immunity under on that 5 lakh rupees will not be available under Schedule 3, which means that second transaction of 5 lakh rupees for renting of commercial complex will be liable to GST. Okay, that is one point. Now, second, look at this. Employee to employee in the course of employment, not taxable. Employee to employer, not in the course of employment, could be taxable, but provided he is in the business. But employer to employee, whether in the course of employment or not in the course of employment, is not covered anywhere. What is covered in Schedule 3 is employee to employer. What is not covered in Schedule 3 is employer to employee. So when employer renders services to the employee, it will be liable to tax. It could be liable to tax. I'm sorry, I will not say it will be. It could be liable to tax. Let's look at certain situations. Also, before that, please look at section 15, explanation under section 15, which says employee and employer are related to each other. So how much ever we hate our employees, or how much ever employees hate us or their bosses, okay, and how much ever they, we get in an unhealthy discussion, okay, we are treated as related to each other because of explanation under section 15. Now let's go to Schedule 1. Schedule 1 says transaction between related parties, even if there is no consideration, will be liable to GST. So we'll have to keep all these three transactions, all these provisions in mind before we analyze whether GST is applicable on a transaction executed between the employee and the employer. Okay. So point number 1, under Schedule 1 itself, if the employer gives gifts to the employee up to 50,000 rupees, it is not liable to tax. But if he gives him gifts more than 50,000 rupees, it will be liable to tax. Okay. So now, assuming there is Diwali, and during Diwali there is a lucky day where somebody is given, say, a mobile phone of 20,000 rupees. If he gets a gift of 20,000 rupees, that will not be liable to GST. Assuming another person gets a laptop worth 75,000 rupees, that is a gift which is more than 50,000 rupees, it will be liable to tax. So now what happens to the input tax credit? Let's go to section 17(5)(h), which says anything disposed of by way of gift will be, a credit on the same will not be allowed. Okay. So now let's look at this. Mobile phone given as a gift, but less than 50,000, so no output tax. Okay. But because it is a gift, I will not be entitled to claim the input tax credit of the same. Laptop more than 50,000 will become taxable because of Schedule 1. Now, once Schedule 1 says it is taxable because it's a supply, Schedule 1 comes under 7(1)(c). 7(1)(c) defines meaning and scope of supply. So that means it is a supply. Once it is an outward supply which is taxable, under the same act, you cannot give separate treatment to the same transaction. So one transaction, if you're treating it as an output tax under 7(1)(c), it cannot be treated as a gift under 17(5)(h) in my view. So you are not required to reverse the input credit. So basically, if it is less than 50,000, you will lose input tax credit. If it is more than 50,000 rupees, you will claim the input, pay the output. So the cost is the same. The GST paid by you, when given to the employee, when anything given to the employee, either you pay it by way of non-availment of input tax credit, or you pay it by way of output tax. But the point is that will be a cost to you, right? Okay. Here again, one interesting issue: after 2017 GST was introduced, 2022 a circular has been issued which says perquisites given to employees are not taxable. So now perquisites we understand from Income Tax Act. What do you mean by perquisites? Okay. But here again, we have to be very careful on what do you mean by perquisites as far as GST is concerned. Now, from a GST angle, it says perquisites provided by the employer to the employee in terms of the contractual agreement entered into between the employer and the employee will not be subjected to GST when the same are provided in terms of contract between the employer and employee. They are repeating the same thing, meaning they are trying to say that if in the written contract something has been given, that the employer is going to extend this as a perquisite to the employee, only then that perquisite which is mentioned in the agreement contractually will not be subject to tax. But anything extra given by the employer which is not mentioned as a perquisite in the contractual agreement entered into between these parties will become liable to tax, subject to 50,000 limit or subject to other provisions of the GST law. So we will have to be very careful in reading the employment contract of our clients to check whether they have promised something as perquisite or not. If they have, GST will not be applicable. If they have not and extended something which was not part of the contractual agreement, GST implications can be there. So let's take a few examples around this perquisite. Okay, I am not giving something free. In income tax, perquisites can be something which is given free, or it can be given at a concession. Okay, so now assuming I am giving to the employee something at a concessional rate. Okay, so if pick and drop of employees is costing me 5,000 rupees, I will say you pay me 2,500 rupees. Or food which I've got at office is say 10,000 rupees a month. I will say pay me only 5,000 rupees. Or I have taken a corporate subscription of gym. I want all my employees to be healthy. My cost from the gym is 10,000 rupees, but I have told them you pay me only 5,000 rupees. Okay. In all these cases, my worry is that even if you add it to the perquisites in the contractual agreement, to the extent it is free, okay, it will not be liable to tax. To the extent it is charged, now the related party transaction will come into picture. And once it is a transaction with related parties, the transaction value cannot be accepted. So the open market value have to be identified. Open market value is the value at which I have acquired the services. So all of these services may be liable to GST. The entire service, the cab hire charges, when I'm cross-charging to the employee, the food, the money what I collect from the employees for food, or the gym subscription, at the actual value, it may be liable to GST. It may be, there are ways to work around this, but they're not healthy practices. there could be a GST liability or exposure on these aspects. Okay. Now, the standard assumption is, as far as ITC is concerned, anything related to the employee, you will not get the credit. I believe that is completely wrong. What is not available as input tax credit is only section 17(5) blocked credit. So if any of the procurements made by me fall under section 17(5), it will not be eligible for input tax credit, irrespective of whether it is for personal consumption of employee or no. So let's take an example. Food, beverages, outdoor catering, whether it is for the employee or for the auditor or for marketing team's meeting or for the client meeting, as long as it is food, beverages, outdoor catering, you will not get input tax credit. So it is not linked to employee welfare. If it is listed in section 17(5), you will not get input tax credit of the same. Okay. Another point is, you look at a lot of transactions which are not forming part of section 17(5). Okay, like uniform given to employees. Can you claim input tax credit of the same? There, the objection which we receive is that it is for personal consumption of the employee, so you cannot claim the input credit. My argument here only is that personal consumption cannot come as far as companies are concerned. When we are talking about companies, companies cannot personally consume anything. It is the employees who are consuming. So personal consumption is for the person who is availing the credit. He is not consumed anything personally. It has been consumed by the people who are working under him in the course of business. So if you look at section 16, subsection 1, anything used or intended to be used in the course of furtherance of business. So this uniform is being used or intended to be used in the course of furtherance of business. And I, being a company, I cannot personally consume. I, being the person who has availed the credit, I cannot personally consume anything. And so even if something is exclusively used by the employees in the course of executing their duties, it will not be, the credit on the same should be available. It should not be required to be reversed. Okay. Now next, if say suppose I am a laptop manufacturing company and I am selling laptops at 1 lakh rupees, but to all my employees I give a discount of 20% and I give the laptops at 80,000 rupees. Again, the issue is that related party transaction will come into picture, because employee and employer related. Transaction value will not be accepted. Open market value will have to be accepted. Open market value is 1 lakh rupees. So even though I am collecting 80,000 from the employee, I am required to pay tax on 1 lakh rupees. Is somebody trying? Is it audible? Everything is clear? Hello? Okay, I heard some, so I can see that it's clear. I'll just start sharing the screen. I'm sorry for the disturbance. Just give me a second. I'll just start sharing the screen again. Just give me a second. I had covered this. Okay. Right. Now let's go to certain transactions which could be executed by the employees, which could be liable to tax under reverse charge mechanism. Okay. So now, assuming my employee who is in Bangalore goes to Mumbai and incurs certain expenses towards hotel, towards cab, or towards food, and he gets the invoice. The point is whether I can claim input tax credit on the same amount. My registration is in Bangalore. The GST number and the GST charged by the vendor will be CGST and SGST, because place of supply, as far as Indian entities are concerned, will be governed by section 12. For hotels, the place where the immobile property is located. Cab, the place where he has boarded the cab. Food, where the person is made available for consuming the services. So in all these cases, CGST and Maharashtra GST will be charged. So input tax credit on the same will not be available. Now let's move this example that I have deputed a person from India to travel to USA for business purposes. Okay. Every month, he gives me an expense voucher for reimbursement of expenses. This reimbursement of expenses are for amounts paid by the employee in foreign currency. This could be for his hotel accommodation. It could be for the cab he's taken for travel locally, or it could be for food which he has had in the foreign country. Now, is it liable to tax under reverse charge mechanism? Now, again, we will have to examine the taxability under section 13 and not under section 12. Is my screen visible? Because I've just got a message from somebody that screen is not visible. Is my screen visible? Okay, I will just share again. I'm sorry. I'm sorry, once again, I'll just share. I hope the screen is visible now. All right, I can see some messages that says that the screen is visible now. Thank you. Okay, so now we will have to examine again whether the place of supply of these expenses is within India or outside India. So when the employee books a hotel outside India, the place of supply is the place where the immobile property is located, which is outside India. So even though I have spent indirectly through my employee money in convertible foreign exchange, it will not be liable to tax. So I have seen a lot of cases where, the GST authorities come, or service tax authorities earlier would come and say, look, you have foreign sent employees on travel, they have given you reimbursement vouchers, it is as good as you have paid for it, multiplied by 15%, you paid tax under reverse charge mechanism. It cannot be levied like that. You will have to check the place of supply for each and every travel reimbursement, and only when the place of supply is in India, it will be liable to tax, otherwise it will not be liable to tax, right? Okay, somebody is saying it is not visible. I'm just reloading again, I'm sorry. Okay, next. Say, assuming, I'm sorry if you're not able to see the slides also, there's nothing much in the slide, it's only a pointer for me to prompt me what is the next topic. So even if you're, I'm sorry if you're not able to see the slide, just bear with me. I will take the points, this slides will be shared with you. Okay, so the second point now is, say, assuming, and this happens in a lot of startup companies I've seen, that they would not have set up their bank account in the correct way, or they are not authorized to make foreign payments. So they will take the director's credit card and swipe the credit card for any software subscription or any Instagram advertisement or Facebook advertisement or LinkedIn corporate account. Okay, so all of these are through the director's credit card. The point now is, even though the expenses have been routed through the director, forget the RBI non-compliance or FEMA non-compliance if there is any. Okay, but indirectly the employee has acted in the capacity of being your agent and executed a transaction. It is not for his own purposes, it is for the purpose of the company that he has executed this transaction, and you have booked that expenditure. So that is a foreign currency expenditure incurred by you, and hence it will be liable to tax under reverse charge mechanism. So please be careful about this employee reimbursement vouchers. Some of the expenses, place of supply, could be outside, no need to pay tax. Some of these could be software subscriptions which will be liable to tax even if paid through the credit card of the employee or the director. Okay, next. Now, when a car is provided to the employee, on car, of course, there is no credit which is available. And also, if there is a renting of motor vehicle by a non-body corporate to a body corporate, GST is required to be discharged under reverse charge mechanism. Okay. Now, a circular was issued, Circular 177 of 2022. There are a lot of issues which have been clarified in that circular, including the famous plots for sale after development. Okay. So there at serial number 15, they have clarified what is the difference between passenger transport service and vehicle hire charges. So the question which came up was whether GST under reverse charge mechanism is to be paid on passenger transport service or vehicle hire charges. So serial number 15 says passenger transport service means a vehicle which is moving on predetermined route at predetermined time, like a BMTC bus. Okay, but when it is a vehicle hire charges, it means you have taken the vehicle, you will decide where to go, you will decide when to go, and you will decide the number of hours the driver has to be with you. So now the circular clarifies that vehicle hire charges is essentially hiring of motor vehicle, and passenger transport service is not hiring of motor vehicle, it is a service of transportation. Vehicle hire charges is liable to tax under reverse charge mechanism, but passenger transport service on a predetermined route is not liable to tax under reverse charge mechanism. So now, if you fund your employees for passenger transport service and for which they claim money from you, you are not required to pay tax under reverse charge mechanism. That is your bus pass or bus tickets, etc. But when they hire a cab to go to airport or to go to department or to go to customer's location, then it is vehicle hire charges which will be liable to tax under reverse charge mechanism. If we extend this logic a little further, if you look at section 17.5, it says renting, hiring, leasing. Okay, renting, hiring, leasing of motor vehicle credit is not available. Now, what does the circular say? Vehicle hire charges, where the vehicle is in your control, constitutes hiring, constitute renting. That means if somebody has charged tax to you for passenger transport services, you will be entitled to claim the credit, even if it relates to a vehicle having a less than 13-seater capacity. Okay, I'm not sure if I was clear on this, but the point I'm trying to make here is that if anything qualifies to be a passenger transport service, I don't think it will be restricted or blocked under section 17.5. You will be entitled to claim credit based on the circular issued by the department. Okay, but when you hire a cab for exclusively your own purposes, then it is vehicle hire charges. You will not be entitled to claim input tax credit. And if you have availed these services from a non-body corporate, then you are required to pay under reverse charge mechanism and you will lose the input credit as well. Okay. Now, another point which is not there in the slide, but I want to discuss with you, assuming that I am providing food to employees and I'm charging also for it. So I am availing services of a restaurant, okay, and getting the food, and I'm charging to the employees. Whoever wants to have food have to pay me the full value. So assuming per meal cost is 100 rupees. So the supplier is charging me 100 rupees. Okay. And I am also charging 100 rupees to my employee. The question now is whether I can claim input credit of the taxes paid on the restaurant services. Okay. So my view here is that when the restaurant charges food to me, charges for the food to me, you look at section 17.5. It says food, beverages, outdoor catering, you will not get the input credit unless it is used for a composite supply or a mixed supply. That means unless I am making a supply out of it, which could be either the individual supply or a composite supply or a mixed supply. Okay. So now I have input and I have an output, because when I collect the money from the employer, just now from the employee, we discussed that I am required to pay GST. Because there is an input and an output, I will be entitled to claim the input tax credit of the money charged by the restaurant owners, the GST charged by the restaurant. It is a different thing that when I charge the tax to the employee, I will pay 5%, and under 5% route, the input tax credit is ineligible. That is because of a rate notification. But I am restricting my discussion only to section 17 subsection 5. Let's take another example. Okay, so let's take an example of say cab has also is restricted. Let's take an example of gym. Okay, we'll take example of gym, which was there in the earlier slide also. Okay, so now assuming I have taken subscription of a nearby gym where they charge me 10,000 rupees. So the actual price was 15,000 rupees. Because I'm doing a bulk booking, they're charging me 10,000. And I've told my employees that, look, if you want, then 10,000 rupees you are also required to pay. Here, the answer could be a little different. Now, on the input, section 17.5 will come into picture, which says health club, fitness center, etc. credit is not available. There, the provision does not say if it is used for an output supply, you will get input tax credit. So 17.5 will hit, so you will not get input credit. Plus, when you are collecting the money from the employees, you have to pay output. So they'll double tax. One, on the output tax. Second, because you are ineligible to claim the input credit, that also will become a cost to you. I'm not sure how effectively I have been able to communicate this, but if there are questions around it, then I would want to discuss or rediscuss this again. Okay. The last slide for 5-10 minutes, and then after that, the floor will be open for questions. Okay. Now, perennial question from the day GST has been introduced. If there is a software company in Bangalore having a branch in Pune, they've got a contract from the US entity to do a project. The Bangalore entity has got the project. They subcontract a portion of it to the Pune entity, say assuming 30%. So Pune entity does 30% of the job, Bangalore entity does 70%, adds everything, sends it to US entity. US entity, of course, will not agree for 2 invoices. So the Bangalore entity raises a single invoice of 100. Now GST says, because you are distinct persons, you have Pune has rendered services to Bangalore, so Pune has to bill 30% to Bangalore. That is a very simple example. But now when it comes to all the other support services, like Bangalore team only does HR interviews, okay, for employing people in Pune, or the legal team sits here, the marketing team sits here. So now we have Pune specific cost incurred by Bangalore, common cost of Bangalore and Pune incurred in Bangalore, and internal cost like salaries, okay, given by the paid by the Bangalore entity, which is also applicable to Pune. So there, how do we work around this entire concept of distinct person? The most ideal situation will be wherever the cost is from a third party, it has to move through the ISD route only. So if Bangalore is paying for Pune expenses, Bangalore will have to take a ISD registration and move the transaction, move the expense to Pune by way of a ISD invoice. Okay. If it is common cost of Bangalore and Pune, like auditor fees, it has to go through the ISD mechanism. 70% will be retained by Bangalore because that is the turnover out of the overall turnover of the company, and 30 will have to be transferred to Pune. Salary cost incurred by Bangalore, whether to be transferred to Pune at all or not is another question, because employees are employees of the company and not of the branches is one argument. Then on basis this argument, there is a case in Columbia Asia, case before Karnataka High Court in case of Columbia Asia based on the advance rulings. Okay, so advance ruling was adversely given in the favor of revenue in Columbia Asia case. Then AAAR also was against the assessing. Then this matter is now before Karnataka High Court. The judgment has not come out. Okay, so I would believe the most efficient way would be if wherever third party is involved, third party vendors are involved, take the invoice as far as input services are concerned, take the invoice in the name of the ISD and transfer the credit either to the specific branch if it relates to a particular branch, or apportion it based on the turnover. And if it's internal cost, if credit is available, okay, then better to cross charge that salary also or the head office cost to the other branch. Valuation becomes an issue, but there we have the valuation rules, rule 28, the explanation, the proviso, which clearly says that when you are dealing with a related party and the related party can claim the input tax credit, then whatever is charged on the invoice will be deemed to be the open market value. So if the other person can claim the input tax credit, you don't have to bother about valuation. A fair valuation, even if little bit here and there, should not make a problem, should not be a problem. Okay. Then let's quickly go to refund. If I'm exporting the goods or services, then I have two options: export without payment of tax and export with payment of tax. When I'm going with export without payment of tax, I'm basically using the formula, which is total input credit at the relevant month multiplied by the export turnover divided by total turnover. Now, when we talk about services, it is the total turnover. When I'm talking about the total turnover, I'm talking, so the export turnover I'm talking about is based on realization, okay, and not based on the invoicing. Next aspect, what is the difference between export without payment of taxes and export with payment of taxes? The major difference is that in case of export with payment of taxes, I utilize my input credit to pay my output tax and I get the entire amount as refund. But when we talk about export without payment of taxes, the entire input credit minus the credit relatable to capital goods is the amount which I am going to get as refund. So if you have a accumulated input tax credit relating to capital goods, which is very, very high, then you might opt for export with payment of tax. Otherwise, you can go for export without payment of tax. Okay. Also, if you want to save the GST cost on capital goods, because otherwise the credit keeps on accumulating and you're a EOU, which is say a EOU or STP, then you can get the goods from your vendor under deemed export provisions. And there, in case of deemed export, either the supplier or the recipient, any one of the two, can claim refund of the taxes charged on the invoice. Right. So now, assuming you have to buy a server, you get it under deemed export if you are a EOU. Okay. You give a declaration to your supplier that I have not claimed input rate and I'm not going to claim refund. Then supplier will be able to claim refund. Or take a declaration from the supplier that he is not going to claim refund. Basis that declaration, you file an application with your jurisdictional officer that on capital goods I'm claiming refund under deemed export route. On the balance input tax credit, I am claiming refund under export without payment of tax using the formula. So both the refund mechanisms simultaneously can operate. Okay. Now, when you have a SEZ, okay, special economic zone, a unit in a special economic zone, and you also have a separate unit outside the SEZ, then mandatorily, even though you are in the same state, you are required to obtain a separate registration for the SEZ unit. Okay, and whatever you acquire for the purpose of SEZ is exempt from tax, provided it is for authorized operation. Now, SEZ will say everything is for authorized operation. So the vendors to the SEZ have to be careful whether it is for authorized operation or not. So I'll give you an example, a very recent case which we came across. Okay, so one of the persons whom we are advising, or who we will start advising, they are a company which handles employee benefits, employee reward programs. Okay, so they will give coupons, they will give, if you earn these many number of points based on the work done by you, which manager awards to you, you can redeem those points for an iPhone, or you can redeem those points for a laptop, etc. Okay, so now this entire engagement program of the employees is run by this company. Okay, so this company at the end of the month, based on whatever has been redeemed on their platform, raises an invoice on the SEZ without payment of tax. So when we asked them why are you not charging tax, they said the supply is to SEZ, and so SEZ is zero and we are not required to pay tax. If you look at the invoice, basically it is it is gift wristwatch, gift iPad, which will never be, or vouchers, travel vouchers. Now, all those products are never going to be used by the employee for the benefit of the company. It is going to be used for personal consumption. Now, how can that be for an authorized operation of SEZ? It is a retention of employee policy, all that is fine. But from a SEZ perspective, is it for the authorized operations of the SEZ? Has it been even admitted in case of during COVID that the gifts were directly being shipped to the employee location? So now, are these goods even admitted into the SEZ? They are not. So then can it be said that it is for authorized operation or not? So whenever it is services, at least we'll have to look at those 67 default list of services given by the SEZ and check whether the client who is supplying services to the SEZ falls under those 67 categories to be treated as an authorized operation. If it is not, then the unit will have to take a separate approval from a UAC that this service is being procured by me and it is for authorized operation. Only then exemption will be available. Now, these are not part of GST law. It is from the SEZ law, because GST only says it should be used for authorized operation. So what is authorized operation? I have to satisfy the conditions of the SEZ law. Third, we can always say that endorsement on the invoice is applicable only when I'm claiming refund on zero-rated supplies. Okay, but very important, even under the SEZ law, there is a concept of endorsement of invoices, both goods and services. So when somebody is supplying goods or services to an SEZ, we have to ensure that the SEZ gives the endorsed invoice. In fact, in certain SEZs which are connected with the SEZ portal, okay, these approvals are being, so the SEZ unit has to upload the invoice and it will go to the specified officer who sits outside the SEZ. He will call for documents if required. He will check whether the goods have been admitted to the SEZ or not, and he will give the approval. And email ID of the vendor will be given. The approval copy will be marked to the SEZ vendor also. So endorsement of the invoice is very, very important. Next, import of services by SEZ, there is a specific exemption. But domestic supplies to SEZ, which are liable to tax under reverse charge mechanism, there is no exemption. So one one school of thought is that for import of service, there is exemption. For domestic supplies, there is no exemption. And that means domestic supplies by SEZ is liable to tax under reverse charge mechanism. The other way to look at it, or the argument is, if you look at 9.3 or 9.4, which says that RCM is required to be paid, it says the recipient will go into the will be placed in the shoes of the supplier, and supplier can supply goods or service to the SEZ by executing a LUT, which means even if it is a RCM transaction, it is as good as the SEZ is supplying goods to another SEZ. Now, when supply is made by one SEZ to another SEZ, the SEZ can execute a LUT and no need to pay tax on the same. Okay, so from that perspective, even domestic supplies by RCM, which are liable to tax under RCM, may not be liable to tax under reverse charge mechanism using this argument. Last point which I wanted to cover, these IT companies spend a lot of money on the fit outs, on the overall employee experience. So I know a company which says every 100 meters from the seat of the employee, whether left hand side or right hand side, he should be able to reach to the food. It could be dry fruits, it could be salads, anything, but he should be able to reach out so from every seat, 500 meters left, 500 meters right, he should be able to access food. Okay, so they spend a lot of money on employee experiences. So they incur a lot of cost on interiors. In fact, there's a company where I've seen where within their office they have a cricket pitch, and they have, meaning in not that they have a ground in their structured building, which is a warm shell. One floor is they have a cricket pitch with nets, and there is a golf course which is there. Okay, so now the question is whether these fit outs credit on the same will be available, or because it relates to a immovable property, and so credit will not be available. If you look at very strictly, okay, section 17(5)(c) and D, it says anything which is capitalized to such property, only then credit is not available. Now, if I have taken the property on rent, I will never capitalize anything to such property, because such property is the landowner's property. I will capitalize to furniture and fixtures or leasehold improvements. So that could be one argument based on which I can take the credit on all these fit outs. In fact, that could be a tax planning where the landowner says, I will not give you fit out. You only do the fit out. Because in case of landowner, there is a possibility that false ceiling and all the other things could be treated as capitalized to the building, and so credit not available. But as far as the tenant is concerned, he is not capitalizing it to such building. So there is an argument possible that the credit will be available. Okay. Second, the credit is restricted in case of construction of that property. The property, as far as the IT company is concerned, the property is already constructed. I'm a tenant. Right. So like our intermediary discussion, if the transaction is executed, then I'm not an intermediary. Likewise, if the property is already constructed, now I am not using anything for construction of that property. So credit again will be available. Third, a lot of these equipments, okay, could be classified under plant and machinery, which is specifically excluded from the blocking of credit under section 75(c) and D. So there also I'll be able to do. Fourth, if it is movable, very interesting one. WeWorks advanced loading is there. WeWorks is a co-working space. They have laid down wooden blocks as flooring, and they have been able to demonstrate that I will be able to move those wooden blocks when I'm vacating this premise. And based on that, strangely, the advanced ruling also, strangely, because they don't give this radical judgment, they said you are entitled to claim the credit on those wooden blocks which have been installed as flooring, which can be moved. So now we have structures which are movable, prefabricated buildings are there, swimming pool which can be moved from one location to another location. So all this though look immobile, but if we can move it from one location to another without causing substantial damage to the structure, we will be able to claim input tax credit of the same. Okay. This is what I had. Now you can see a QR code on your screen. What we have done is to help all our friends, fellow members, we have created a community. You can scan this and you can reach out to us. If you have any questions, you can feel free to ask those questions to us. Okay, so I will leave it for a minute, and then I will exit the sharing mode and take up all the questions one by one. I hope you have scanned the QR code. You will automatically get added to the community. Right. I'll just exit. Anyways, this PPT will have this community code. I'm just exiting the share mode. Okay. With this, if some of them are complaining that it's not, you are not able to scan, you just send a message to me on the number which was available, because I can see a lot of people have already scanned. Okay, so with this, I finished whatever I wanted to cover. Thank you very much again to the Pune branch for calling me. The session is not over. I'm still going to look at your questions. Okay, so thank you very much to everyone to participate in such large numbers. Let's take questions one by one. If consideration is received in INR from Indian bank account of a foreign company, can it be considered the same is received in INR as per RBI guidelines? I don't think so, sir, that it will be treated as a receipt of money in INR. You will have to satisfy the condition which has been given under 7C. And 7C is a special rupee nominated account will be created in India by the entity. Now, from in that, the money will have to come from a foreign bank account. Okay. Then, suppose an employee is given special bonus like a patent bonus because the employee idea got patented. Such bonus is not covered specifically in the employment contract. But I would think bonus is discretionary. At least you would have said that you will be given a bonus. Okay. So again, so from that perspective, it will not be liable to GST. But just look at it from the perspective of assuming it is liable to GST. The point is employee has received the bonus. So he is the supplier. he is not in the business. Employer is in the business. So even from that perspective, even if you give the bonus to the employee, it will not be liable to GST. This is Sagar has a very interesting question. Generally, I used to give that answer. Okay, what the diamond businessman from Gujarat was, who was in news for gifting cars to employees in Diwali, would have done regarding GST. Trust me, after GST has come, I have not seen that news at all. That Gujarat diamond merchant is given diamond or cars to, or the flats to the employees, because he realized that if he gives, then he will either have to pay output tax or he'll have to reverse the input tax rate. Nitin sir's question: if immobile property is movable, then can we claim ITC under section 17.5? Nitin sir always has very interesting and tricky questions. But my only point, sir, is if immobile property is movable, how do you say immobile property is movable, sir? If you can just elaborate a little by way of follow-up question, it will be helpful for me. I can think of recently a client was constructing apartments, okay, and he was under 12% scheme, and he got a swimming pool. So swimming pool, not a regular swimming pool, it's a big container kind of a swimming pool. And he was able to get a certificate from the vendor that if you want to move the swimming pool in the same location, or you want to move it to another location, we will support you, and it is possible. And they have done it also. So now that that swimming pool, because of development of technology, for the time being appears to be immobile in nature. But if it can be moved without causing such structural damage and can still be used, I would believe it is not immobile, and so the credit should be made available. If Nisarg Bhai's question is, if commission received in USD as commission, then whether it is export or service. Sir, you will have to examine whether you are an intermediary or not. If it is commission, then you are an intermediary. Even if you have received the money in convertible foreign exchange, the condition which you are not able to satisfy is that place of supply is outside India. Because in case of intermediary, the place of supply is place where you are located, which is in India. So it will become liable to tax. I think in the chats also there are a few questions. I'll just go to those chats also. Oh, there are around 70 chats. I'm sorry. I can see only one question there. If guys, if you can just give your questions in Q&A rather than chat, because chat I can see a lot of audible, not audible kind of things. Only one question I can see. I will just read out that question. That's from Swati. If a person is providing consultancy services from India to a foreign company is making payment to his authorized bank in foreign currency, then converting it to INR, bank is transferring it to service provider in INR, is it export of service? The point here is now whether you will get a FIRC or not. If you get a FIRC, even if the money is getting converted to INR, that is what the role of the bank is. Because I, as an individual, if I don't have a EFC account, I cannot hold the money in foreign currency. It will have to be automatically converted into rupees. But if the FIRC or BRC can be generated in my name, where the bank is confirming that the amount was received in convertible foreign exchange, that will be a sufficient proof that I am entitled to the benefit of exports. Okay, I can see a few more questions. Mohan Pranchpesar has a question. If a company is engaged in exempt services and company is providing exempt services outside India, then is it required to register under GST and obtain annuity? Now, good point, sir. If you look at section 16, section 16 says zero rating benefit will be available to both taxable and exempt supplies. So even if it is an exempt supply, in India, if you render the exempt supplies, you're required to reverse the input credit. But if you're rendering the exempt supplies to outside India, you will get the benefit of input tax credit because zero rating is available even for exempt supplies. Okay. So now that would mean, I would think it is better for you to register and execute LUT because the exempt supply has been given the status of zero rate supply. So if you have input credit with you, you will be able to claim refund of the same. Okay. There was a news in USA that one person was able to move his residential property from one location to another location. If such option is permitted and enabled in India, then can I claim ITC under section 17.5 of the CGST Act? I think so, sir, because according to me, what is immobile is if I give my Google Map location and the Google Map location goes to the same place, that means it is immobile. But that house is moving to another place. So Google Map location is now left-hand side of the road instead of the right-hand side. Then it will become mobile. I am not sure, sir, Nitin sir, I'm sure you're pulling my leg, but I'm not sure about this. But if this is possible, I think credit should be available. Nitin sir, your question is followed by Nisarg sir. Prefabricated warehouse fixed in earth, can credit be available? So now, if the structure is such that it cannot be moved at all without causing damage, then you will not get the credit. But prefabricated warehouses we have seen can be moved as is. It can be uninstalled and installed again. I believe credit is available, sir. Nisarg sir.
Sir, can I interrupt, sir, in between?
Yes, yes, sir. Yes, sir.
Sir, just to add to Nitin sir and Nisarg Shah sir's factual position, to establish whether the goods, the thing is movable or immovable, there is a many Supreme Court judgments. You can take the name as Triveni Engineering, Supreme Court, so in which it is specified the goods should be as it is moved to the other place.
Correct.
In prefabricated house fixed in earth, you have to dismantle it. If you have to dismantle it, it cannot be said as it is a movable, because name and nomenclature will change once you dismantle it.
I disagree a little with you, sir, on that. But that's also a good way of looking at it. I have a different view on this. Even if dismantled, but can be assembled the same way, I still believe credit will be available, because there's one very interesting judgment, sir. Again, these all knowledge is from excise only, sir. In GST, it lost relevance. So one of the cases, what had happened, capital goods were liable to tax at the rate of 12.5%, and parts were liable to tax at the rate of 15%. So a person from Bangalore had ordered in Ludhiana that please send me crane. This crane had so many parts that it had to be transported in 4 trucks. Now, when the excise officer saw, because that at that particular point of time, we have to take the approval of the excise authorities before I can move the goods. Okay. So that particular point of time, the excise officer said, why are you charging 12.5%? Because what I can see in the trucks is the spare parts. One part tire is there, one part engine is there. I cannot see the crane. Crane is 12.5%, but spares is 15%. So you should charge 15%. Now, this matter, when it went to tribunal, the tribunal said very interestingly, the assessee or the manufacturer is not transferring parts of the crane. He is transferring crane in parts. So the tax applicable is 12.5% only. So a different user, but interesting point which you made.
Understood.
Okay. Okay. Then few more questions are there. Santosh Bandre sir is asking a question of whether intermediaries should charge CGST, SGST or IGST. Sir, one very interesting judgment of Gujarat High Court. I was just trying to find out the citation. I'm not getting the citation, but it is Material Recycling Association of India. Okay, where a writ petition was filed questioning the validity of levy of GST on intermediary services, saying that though the services are received outside India, you're still paying tax. You're asking me to pay tax on the same. There, the question was never whether CGST, SGST, or IGST has to be charged. The validity was questioned. There, if you see indirectly, the person appearing on behalf of the revenue also indirectly admits that it is a CGST and a SGST. Okay. Now let's look at the place of supply provision also. I am in Karnataka. Okay. Intermediary services, place of supply is the place where I am located. I am also in Karnataka. So this is an international transaction, but still CGST and SGST will have to be paid. But is there any judgment around it? As of now, no judgment. There is a obiter dicta you will find in Material Recycling Association of India versus Union of India case. Gujarat High Court judgment challenging the where writ petition was filed, challenging the levy of GST on intermediary services. If an employer gives car to the employee paying GST, can he claim it on original purchase, as car might be registered in employee's name? No, on gift of car, credit will not be available because section 17(5) specifically restricts credit on car. So credit will not be available. Mohan sir, again question. Companies exclusively engage in exempt supply. Okay, so Mohan says follow-up question to the main question was, I am making only exempt supplies. Am I required to obtain registration with the GST law and execute LUT? Sir, theoretically, the answer is you are not required to obtain registration unless your turnover crosses 20 lakhs. Theoretically, because section 24 also exemption has been given. If you are making interstate supplies, which is up to 20 lakh rupees, you are not required to obtain registration in case of interstate supplies also. But I think it would be in your interest to take the registration. Theoretically, you can argue that registration is not required. I think I've answered all the questions. If there is anything, I would be more than happy to answer. But all the questions I have answered, sir. Rajesh sir. Okay, there is one more in chat. Okay. Sorry, 1 second. I will take that also.
ITC will be eligible or not on flight tickets commission.
ITC will be eligible or not on flight ticket commission. On flight ticket commission, you will get. So if Make My Trip, you book anything on Make My Trip, one, you will get an invoice from Indigo for the flight charges, and second, you will get from Make My Trip for the convenience fee. On both, you can claim the credit.
I think we have to see section 17.5. These things are not there in 17.5 blocked credit. So
Correct.
we can take a credit.
As long as it is not in 17.5, you can take credit on everything unless used for exempt.
Yeah.
Or
again, we have to, sir, there are multiple things. We have to check whether the expenditure are personal in nature, business, many factual position we should verify.
Correct. Agreed, sir. I agree with you.
So one question is that training to abroad from India, whether it is export. I think after completion of session, we should not ask this question because we have already completed place of supply and the related provisions.
Right, sir.
It is export of service, considering the other factual position, it is export of service.
Correct. I think Sanand sir's point would be, if the person has to go there for training.
Not required, sir. The person is in India only. He said from India. Training to abroad from India.
Yeah, so reverse case, he's saying that assuming I am in Bangalore, I am providing training services to a person who is located outside India. If the person is outside India and attending the classes, it is export. But if the person is required to be made physically present in Bangalore, then that section 13, where the goods are made available, where the services are made available, that provision will come into picture. There it will not, place of supply will become India, so it will not be what you say, export, so it will become liable to tax.
Again, factual position we have to check.
Yeah, these are all factual. Correct. Okay, great, sir. Anything else is there? I'll be more than happy to address.
Sir, excellent deliberation, sir. Excellent. You have covered even some provisions outside the IT ITES also in FAQ. Question answer session we have covered ITC also. Thank you, sir. It is really
it's indeed a pleasure for Pune branch to have you.
Definitely my pleasure, sir, to participate in this mega event which you are conducting.
See the feedback members has given. All has given. It's a great session.
Thank you guys. Thank you very much. Thank you, sir.
I think someone has added mobile application subscribed by buyer out of India, whether it is export of service.
So there is one question.
Yes, sir.
It's a good question, sir.
Mobile application subscribed by buyer out of India, whether it is export of service.
Oh, good point. So if I am in Bangalore and I have developed an app which is placed on Google Store, now I am getting the money. The point here is that how am I getting this money? I will be getting through PayPal. No other mechanism. Their FIRC and BRCs are not able to be generated. So there is no proof that I have received the money in convertible foreign exchange, because PayPal receives this money, converts it and gives it to my linked account. So in my account, I have not got the money. So again, I am told that a lot of startups have approached the government to get a clarification on this, where they are not tied up with the bank, but they have tied up with these third-party vendors to get the money. So this clarification is still not come, sir, actually.
Sir, one request, member is asking whether we can upload this PPT on Pune website, Pune branch website.
100%, it will be my pleasure, sir, if you can upload.
Yes, sir. Thank you, sir. Thanks for your permission, sir.
I will share it with you, sir. I will share it with you over email, sir.
Yeah, please, sir. Please.
Right, sir.
So I think we are done with almost all the questions. So if there are any specific questions, probably we can get in touch with Hanish sir, so that we can have the answers on email also. So,
Right, sir.
so thank you so
Definitely,
much.
sir.
It indeed was a pleasure for us to listen to you and getting enlightened with this complex topic.
Likewise, sir. Likewise. Thank you so much.
And thank you all the participants also to spare their time for this GST series and patient hearing. Thank you so much all.
Sir, just we have declared this program virtually to catch maximum members. Being Pune, also now there is a traffic problem. We could not invite you at Pune to take this session, but definitely, sir, we like to hear you from at Pune by traveling all the way from Bangalore to Pune, sir.
100%. I keep traveling, especially for Canny Bakery biscuits. I keep traveling to Pune. So I will definitely come, sir. No, it will be my pleasure.
Yes, sir. Yes, sir.
Thank you, sir.
Sir. Thanks
I
a
log
lot.
out, sir.
Thanks to all participants.
Thanks.
Patient listening. Yes. Thank you, sir.